Hello and welcome to this presentation. My name is Simone. I'm an accountant and a financial analyst, and today I will explain the closing entries and the difference between temporary accounts and permanent accounts. This presentation is divided into two parts. In the first part, I will explain what are the closing entries, what are the temporary accounts, permanent accounts, and the difference between temporary and permanent accounts. Instead, I'm going through a practical example in the second part. I would remember that the material related to this presentation, along with other accounting materials, are inside my website vatradi.com. I would also remember to subscribe. The subscription is quick, is free, is important for you, that you are notified when the next videos will be available. It is also an indication for YouTube, which can use this video for others looking for the same argument. So many thanks in advance if you subscribe, and we can start now. I start by explaining what are closing entries. So closing entries are journal entries recorded at the end of an accounting period to transfer temporary account balances to permanent accounts. So we are at year end, we need to close temporary accounts and move the result to the permanent accounts. So what are temporary accounts? Temporary accounts are the GL codes inside the income expenditure, and temporary accounts are financial accounts that record specific transactions for a defined period of time. And as I already said, their balances are closed at the end of the accounting period and transferred to the permanent accounts. So, what are permanent accounts? Permanent accounts are balance sheet accounts that are not closed at the end of the accounting period, but their balances are moved to the following accounting periods. And this creates a big difference between temporary accounts and permanent accounts. Why? Because at the end of an accounting period, the balances of temporary accounts represent only the transaction recorded during the accounting period. Instead, at the end of the accounting period, the balances of permanent accounts are the total of their open balances plus the transactions recorded during the accounting period. Because, as I already said, the permanent accounts are not closed at year end. So when we are going to the next financial year, we have an open balance plus the transaction of the period. Instead, for temporary accounts, we have only the transaction of the period. And I'm going now in Excel, and I will show you my practical example where I explain what I said until now. So please remember to subscribe to my channel, and if you have any comments, please leave below. So I'm inside Excel, and I started to explain my practical example with the chart of accounts. So in relation to the chart of accounts, I prepared two different videos that I leave you below in the description. The chart of accounts is a list of code that an accountant needs in order to record journals inside the accounting software. And the chart of accounts is structured in order to mirror the two main documents inside the financial statement, the balance sheet and the income expenditure. And in general, every chart of accounts starts with the GL code with number 1, which are going inside the asset of the balance sheet. We have after the number 2, liabilities, number 3, capital. So these GL codes are called permanent accounts and are going inside the balance sheet. Instead, the GL codes start with the number 4, are income usually, number 5, cost. The GL codes 4 and 5 are called temporary accounts and are going inside the income expenditure. So now we need to consider an accounting period. In this situation, I consider a financial year from January to December 2025. And every day an accountant records journal inside the accounting software. And this is an example. Vatradi purchased materials for 10,855. The amount is paid immediately. So in this situation, the journal, we have the date of the transaction, we have 2GL code, and we have an amount in debit and an amount in credit. So this journal creates amounts inside the T account of 2GL code, like this situation. In this situation, I have that the material is going in debit for 10,855 and is going inside credit for the bank for the same amount. So if we consider that inside an accounting period there can be thousands of this transaction, there will be amount in debit and credit for every T account of every GL code. So at the end of the accounting period, we need to calculate the balance of every T account, like in this situation. In the bank, I have amount in debit, amount in credit, amount in debit and in credit. In the end, the balance will be in debit for 104,403. Instead, for material, will be in debit for 15,377. So the list of GL codes with a balance at the end of the accounting period create the trial balance. And this is my example for this presentation. My trial balance from the 1st of January to the end of December as bank for 104,403, which is the balance of the T account. I have building, machineries, account payable, mortgage, share capital, return earnings. These are permanent accounts that are going inside the balance sheet. After this, I have the temporary accounts that create the income expenditure. So now, the question what is? This is the trial balance at the end of the accounting period, but this is not the trial balance at the beginning of January, because at the beginning of January, the trial balance will be different. This is the trial balance at the beginning of January. And as you can see, the balance of the bank not changed. As for building, machinery, account payable, mortgage and share capital, these are all permanent accounts. However, what changed is the amount of return earnings, which at the beginning of January is 28,881. Previously was 27,238. So now what's happened? That at the end of the accounting period, the software prepared the closing entries. And when there are the closing entries, the temporary accounts are closed and the result is moved to the permanent accounts. The software creates one journal to close all the income, one journal to close all the cost. The result is going to the permanent account. And this is the example. In this situation, I have that, for example, my income that was in credit is going in debit in order to be closed. And I use a GL code called income summary, which is used only for the closing entries. The balance is going in credit. When I close the cost, is the opposite. The cost go in credit, the income summary go in debit. Now what we have that we need to close the income summary with the final journal that transfer the result to the return earnings. In this situation, I have 1643 because 1643 plus 2812 is giving me 22455. In this situation, income summary has closed its job and the result is moved to the permanent accounts. And in real life, the situation is not so different because there can be a lot of manager codes, but the process is always the same. You need to record journals with balances that go on the opposite side in order to close cost, in order to close income. The result is going to the permanent accounts. So this is my presentation to explain the closing entries and the difference between temporary accounts and permanent accounts. If you have any comments or any question, please leave below. Remember to subscribe to my channel, it is very important for me. Thank you very much for watching my video and we see you to the next presentation.